Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, March 2nd, 2022, and this is Blockhead Traders Weekly. In this week's episode, we're going to take a step away from the crypto markets and go back to the world of equities. But before we hop to this week's episode, I want to give a shout out to the Discord, link in the description below. You can click on that link, say hello to myself, Viper XL, or any of the other traders that are in the Discord in any given day. But before we hop to this week's episode, I want to give a note that we had a few little recording snafus on here. Some of the settings were a little bit off, and so portions of the video are quite a bit choppy. I've tried to edit and cut out most of the ones that were completely unbearable. So you'll find a little bit rough transitions in some of the videos, but let's hop to this week's content. And this week we are jumping back into the world of equities. We've spent a little bit of time in crypto, and there's a lot going on in the equities world. Volatility is rocking it, which makes it prime time premium selling environment. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, a few of the other traders. We hanging out there most evenings throughout the trading day. Love to hear what you're trading. Love to hear what you'd want to see from us as far as content goes. You'll also find a link to thetagang.com/sprocket888. I post each and every one of my trades, the good, the bad, and the ugly. But let's hop to this week's content. Taking a look at the equities market. And Viper, volatility is abound out there. And if you happen to have seen much on our channel, we love, or particularly I love volatility because the option premium is very high and I love to trade the option premium. So I want to take today's episode and I want to take a look at what does it mean to actually sell that premium. So I want to take a look at some of the opportunities that are out there. I want to size them up into three categories: a small, a medium, and a large position. Viper, I know you hang out in the crypto world a lot, but have you seen some of the market action lately?
Indeed I have. Because, like we've talked about before, that it parallels closely between the two. So usually when one's volatile, take a look at the other and vice versa. And yeah, so I don't have a ton of equities plays on currently, though I did just close one up that finally closed out, capitalizing on the volatility. And in that case, volatility was a while back before recent events. And so it was actually theta burn, getting into like 16 days to expiration and just kind of closing up shop there. That one was about 80% profit, I think. But as you said, you've been keying me to the incoming volatility. And so, sure enough, options and opportunities abound is for sure. And I haven't taken any of these yet, but there are a lot of really good options to be discussed, like you said.
Yeah, so let's kind of hop into this. And the first thing I want to just touch on is really how I screen for this. And you can look in past episodes, we've gone through this before. I'm just going to do a quick jump in through this a bit. I use the platform Thinkorswim. And so I have a screener here in Thinkorswim, and really it revolves around just a couple of key metrics. And it's really just the first, I'm going to call them four things that I do. The first thing I do is I'm looking for underlyings that are greater than $15 is a low price that I put in there. A lot of the premium just isn't really worth it below there. Plus your volume in the option market just really is not there. So I put a floor around 15. I do not put a ceiling on it. So I say, hey, look, Just show me underlyings between 15 and whatever. The next very important thing is the actual volatility. This is not the historical volatility. This is the volatility at this exact moment. I personally find that about 30% or higher is a good place to start looking. Now, that's not really, I go off of historical volatility, and I'll touch on that in a second. But I pretty much find that if the volatility is less than 30, your historical volatility is never going to hit. It just makes noise in your screener. So this is one of the parameters that I kind of change, but this is current volatility, and I typically go from 30% to infinite. I put no ceiling on this one either. The next one is very important. This is where volume is key. Being able to get in, get out. I do not touch anything if it does not have volume. And so I change this screener here and there. But basically, I am looking for at least 1 million shares of volume on average over the past 30 days. So these are your big names that you've heard of. Your Citi, your Apple, all of these high volume trades. And then the very last thing that I look in, and I kind of add this, I kind of throw it away depending on there, is their earnings coming up. There's a bunch of other screeners down here. Ignore these. This is more trend following that I'm trying to tweak a little bit. It's looking for something that's coming back to a moving average versus pulling really far away from a moving average. So it doesn't really matter. This list, I'm really looking for just high volatility. And normally my screener, let's say several months ago, 2 months ago, maybe pulled 30 to 40 tickers. It's pulling 162 tonight. So volatility is out there, and companies are really up there. So once I get the list, the very, very most important filtering that I do is this column for IV percentile. And what that is it's saying, hey, what is this relative to itself? What percentile, given the past year, is the volatility at? So something that is at 100% IV percentile basically means the volatility at this exact moment is the highest it has ever been in the past 52 trading weeks. Something at 70% IV is saying, hey, this is about only 30% of the time in the past 52 weeks has this volatility been higher. So you're on the upper end. And the reason this is so important, because one, higher volatility means higher premium, but when you extend up on the IV percentile, you are extending beyond the mean. Okay. As any trader that has kind of spent time in the market, everything tends to revert to a mean. Prices, they go up, they go down, they go up, they go down, but they all kind of gravitate back towards that mean or center level. Same thing with volatility. So this is just like trading the price of an equity, except you're trading the volatility in the equity. So I like the ones that are extra elevated because there is a higher likelihood that those are going to come down in volatility. When things go down in volatility, the premiums get smaller. So I can sell premium when it's high, and as volatility comes in, I can buy it back for a cheaper level or a cheaper price, which makes my profit the spread between those two values. So first thing I do is sort this list by IV percentile. And I would kind of scroll through here to see if there's any interesting names that jump out at me that I want to look at. The first one that I kind of bumps out to me is BP. The reason BP is jumping out to me is because it is an oil company. It is a fuel company. The current events out there are oil prices are going through the roof with the conflict in the Ukraine. There's a lot of volatility. This looks interesting to me. And so I'm going to go ahead and I'm going to pull this up. And the first thing I want to show you about here is I'm going to look at this chart here, which is the history of volatility over the past year. And you can see right here in the recent events, volatility has really spiked. We got all the way up to about a 53% volatility. We fell off a little bit on the trading day, but you can see and look at how many times we've peaked up here. Every time we peak up to this volatility, we don't stay there very long. So this is an excellent example of an increased volatility where I might try to want to snag some premium. What does that look like on the option chain? Well, let's go ahead and take a look here over at the option chain. So here's the option chain on BP. I like to go out between 35 and 45 days to expiration. I like the monthlies. You can sell weekly options. The volume is lower. The liquidity is lower. I just don't touch them. I tried it for a long time thinking, oh, I can get closer to that magical days to expiration. But all the big money, all the traders play in the monthlies. So just go to the monthlies. So I'm going to scroll down here and we're going to take a look. So BP, you can see it's trading at $30. And depending on what you want to do with the stock, really is where you pick the strike. Remember, you're going to get a better price no matter what strike you pick because volatility's high. One of the strategies I've been deploying lately is I sometimes want to own the underlying, but I want to kind of get it at a discount. And so you can take the chart and you can choose the strike that you like based on what price would you want to buy it at. And you can collect the premium off of that. Now, a lot of times when my goal is to own something and I think I'm bullish on it, I will actually sell an at the money put. So whatever the current stock price is, I am going to sell that strike closest to the money on the put. That means that if that put were, or if that stock price were to decline, I would be assigned at that price. If it goes higher, I keep that premium, but I do not get the stock. And so depending on where you might want to enter, you might choose different strikes. Now, BP is at $30, so we could say I'm going to sell the 29 put. That means I'm going to collect $1.17 for this strike. And if I get assigned, I would effectively be buying BP for $27 and some change because you get that $1.17 goes in your pocket. So in BP's case, I like BP. I think it's going to go up. I think the current conflict that's going on in Eastern Europe is likely to keep prices elevated. Oil companies, stocks, and energy stocks have just gone sky high. I feel like I'm okay selling right at the money. So I'm going to sell this 30 put. And that basically means I need to spend, I'll collect $1.60 on 100 shares. So I collect $160. And if BP keeps going up, then I just keep the $150 or $160, and I guess I don't get the shares. If BP comes down because it's volatile right now and gets there at the expiration point, I'll have to buy 100 shares at $30, $3,000 out of my pocket. If I'm long BP and I'm interested in buying BP, great. I actually save $1.60 a share because I collected $1.60 a share. So I really entered that around $28.40. So this is where you get this really inflated premium where normally a much lower volatility might have this at the money strike on this same underlying, maybe around the 80 cents range. So we're really doubling what we can kind of collect due to this higher volatility. Viper, do you have any takes on BP?
I do. So I kind of want to balance here and just kind of bring in some additional, we'll call it color to the idea here of what Sprocket's talking about when looking at like thinking that it's going to go up and when and where to take a strike at and things like that. So I'm not going to be this detailed on all the charts that we talk about, but I kind of wanted to start zoomed way out and then kind of drill in real quick to show you where you could back up some of these thoughts with some more tangible evidence in chart reading and price action and things like that. So we're looking at the entire history of the BP chart right here. This is the monthly view going all the way back to 1968 and then all the way to present day. And a couple of things stand out. So obviously we hit an all-time high here in 2008, 2007 into 2008. And we've clearly been in a downtrend of sorts. So roughly somewhere along here. And that's important to first recognize is where is the trend currently at, and then kind of go from there. And so clearly it's in a downtrend since the all-time high. However, we can also look to say, well, what is a reversal going to look like? Because if we think that we're bullish on something, obviously if it's showing signs of a downtrend, it needs to have signs of a reversal to recover out of that. So if we want to take a look here for what does this need to do to confirm a reversal of trend, and basically we need to recover the last level lost. And so the last swing that we had here was around here, and this was a swing that failed to be held. And so we swung up, we came down, and then right here we can see we lost the level. But now we're getting into, we need more data. We're looking at the monthly. This clearly we see we lost the level, but we don't see a lot of reference points to help make a decision going into this particular trade analysis. So let's just hold this level here because that still is going to hold, and it probably reveals itself if we look a little deeper. So then we go into the daily chart here, we zoom back, and sure enough, we can see, yeah, there was a day. We closed back there at that level. So the purple line represents what we need to hold. We need to gain it, and we need to hold it. And if we do that, that's a reversal of the downtrend because we've reclaimed that level and we've gotten support to show it going forward. So what Sprocket just talked about here, let's throw another mark here that the cost basis of that play was, well, oddly enough, let's just stick with the purple line, 27.16.
No
Because
way.
I think that that's what we kind of came out with there when you factor in the premium that you're collecting. So what do we see in the chart? Obviously, we lost the level. So we come down and then we come up, we test it, we fail the test, we come up, we test again. This is noisy. So this may not be, because, again, you're not going to stick these levels perfectly. So this may not be considered a failure. This could be considered support. And now we're kind of coming back down, and I'll make this a little bigger so it's a little easier to see. We kind of came back down, and we're now in the mode of we have to hold this level. So we have to hold this 27.16 to maintain that uptrend. And now that kind of ties into that purchase price a little bit, because that's a pretty solid buy point if we think that the trend is reversing, and it's a deal if it holds and we don't have to sell off at a loss or anything like that. And so then one of the last points that I like to look at occasionally is a little trend channel here to see, how is this thing looking overall? And so again, this is all based on if we have reversed, this is kind of what the channel should potentially look like, kind of constrained slightly. The price we would expect to move in this channel upwards if we're going to confirm it. And so now another thing that I like here is that going forward, we shouldn't really come back to the 27.16 on the presupposition that this trend is going to hold. So that potentially makes it an even nicer play for the premium volatility aspect of it. It potentially maybe not a great play if you really, really, really want to hold the shares, because it just may never get to assignment based on what we see here. But for the bleed off of that premium, of that volatility, theta decay, all that kind of stuff, this looks pretty good that you could win that direction. And then, like we said, maybe it comes back down and we hold below 29, you get assignment, but you wanted those shares anyways. 27.16 seems to be a great price to have those shares, and then maybe set a stop loss, based on risk mitigation, based on whatever. if you got assignment of those shares, and then you're just kind of playing out the hand you were dealt. So at a high level, zoomed in a little bit, that's kind of what I see there. So I don't know how that strikes your opinions, Sprocket.
Yeah, I mean, exactly what you said. If you're really after these, that potentially is a great price. If you don't get them, well, okay, bummer, but you're left with a not a bad consolation prize. And I really like to take the opportunities of high volatility to go check the names that you want to build a portfolio with. If you want to build a long portfolio, BP, they pay about a 33-cent dividend per quarter. On 100 shares, that's $33 a quarter. So if you want to enter BP, you might as well not put that buy order out there. Throw cast your fishing pole out there with this premium selling. If you get assigned, wonderful. You now have the shares you wanted anyway at a discounted rate because you collected that premium. If they keep going up, well, bummer. You guess you didn't get your shares, but you keep that premium in your pocket. And when you're playing with that 30 days to expiration window, that's a pretty good investment for $160 turnaround on about in this case, it was about a $750 risk or buying power reduction. That's a heck of a return in just 30 days.
Yeah, and that is another good point. Like you said, if this is part of your long portfolio vision, which obviously a staple stock like BP probably could be on that. We don't need to go back to it, but if you look at the chart and remember when we saw the full view, it's pretty low on historical prices. So if you're thinking 5-10 years out or longer that this is going to be part of your portfolio, even if you get assignment and you don't set the stop loss and we lose that 27.16, we're still pretty near historic lows. So while nothing's guaranteed, your risk tolerance, your risk mitigation on that long time frame, the historic pricing is in your favor that on that long time frame, things could still come out plenty fine, and this would still be a great deal on that long time frame.
Yeah. And you can even scale in this way. So, you save some of your money, hold it back. If you lose that level, you get assigned these at 30. You keep the premium. If we fall more, guess what? Volatility is probably going back up. Volatility's up, sell again. Sell another put down there at the 25 level, wherever it's falling down to. Don't just put these buy orders out there. You might as well collect some premium on it. That's the point. So that's really what we wanted to call out here today in this time of elevated volatility when everyone's like, oh my gosh, the market's going down, sell, sell, sell. That's usually the right cue for taking a look at volatility selling and potential entry points, because when everybody's running, you can find some good deals and there's a lot of things that are on sale. There are many cases where people are running for good reason. So don't just buy anything that somebody is running from, but take a look at it, because a lot of good product gets damaged in panics, in sharp drops and sell-offs. And if you're creative and you understand pieces of the market, such as premium selling, you can really even kind of juice your entry a little bit more. So don't be boring and set that limit buy. Be exciting and sell some options. That brings us to the end of this week's episode. Hope you enjoyed a look at some of these creative ways to go long in stocks while creating a little bit of juice and premium on the side. It's not just a buy and hold. It's a little more exciting to enter. Good luck out there this week. Please take a look at all of the boundless opportunities that are there, and sure there's more to come, as the only thing that seems to be certain right now is uncertainty, and uncertainty always drives volatility, and that is the best environment for premium selling. So good luck out there this week, have fun, and remember, think outside the block.